With all this current talk about the inevitability of the stock market crashing, you might be asking yourself the question, is it possible to have a recession-proof portfolio? To answer this question, let's go back to the 1929 stock market crash. What if you were a young investor in the 1920s? Would you have lost everything? All right, come on, let's go. Let's go, come on. With so many people today predicting a recession in 2020, there's a lot of fear surrounding investing in the stock market. We constantly see headlines like, the 2 big reasons there really might be a recession in 2020. And many people point back to the stock market crash of 1929 and are afraid of a similar recession today. It all started on Black Thursday, October 24th, 1929. Over the next few days, the market fell 23%. On October 29th, investors lost an estimated $14 billion, and by the end of 1929, $40 billion were lost. The stock market had peaked on September 3rd, 1929, with a record high close, and by the close on October 29th, the market had fallen by 40%. By 1933, at the height of the Great Depression, unemployment rates rose from 3 to 25%, and those who still had jobs were paid far less in wages. But we do know that there were some people that not only didn't lose everything in the stock market crash, but actually came out ahead and made a lot of money. Now, some of those people were using strategies like short selling, for example, but that's a topic for another video. In this video, we're talking about long-term dividend growth investing. So the question is, if you had a well-diversified portfolio in 1929 and you kept your money in the market and even added more, could you have come out ahead and made money, or would you have lost everything? Let's do some calculations and see. So for the sake of our hypothetical investor, we're going to assume a few things. Firstly, we're going to assume that they started investing in 1926 and then retired in 1956 after a period of 30 years. We're also going to assume that they invested all of their portfolio into the S&P 500 index, which at the time was called the Composite Index or the S&P 90, and it wasn't until later in 1957 that it expanded to include the 500 components we now have today. Now, to gather all this information, I used a really helpful website that gives all of the S&P Index annual returns since it first started in 1926. I'll put a link down in the description. Now, it's important to note that these annual returns include reinvested dividends. Now, I took all of the annual returns from 1926 to 1956 and painstakingly added them all into a calculator and then averaged them out. In fact, you should really give the video a like just for that. You're welcome. And I found that through this period from 1926 to 1956, the S&P index got an average annual return of 13.48%, almost 13.5%.
And I calculated it twice, so I'm pretty sure that I'm right.
Now, if you don't factor in reinvested dividends, you get an average annual return of 9.97%, which is still really not bad at all if you consider that this is during a period that includes the absolute worst economic recession in the history of the United States. So this means that if you were a young investor in the 1920s and you invested all of your portfolio into the S&P index and kept your money in the market, even with the stock market crash of 1929, you would have made a better average annual return than the last 30 years. And when I first did these calculations, this completely blew me away. And that's partly just because I've always been under the impression that all investors lost everything during the 1929 stock market crash. So this is just amazing. Now, I know that many people did in fact lose their entire portfolios in 1929. But my point with this, and what I think it shows really well, is that if you have a well-diversified portfolio, it is possible to ride out even the craziest of recessions, like that of 1929. Now, I'm not saying that you should only invest in the S&P index. I definitely think that you should diversify more than that. But this got me thinking, even if you only invested in the S&P 500, is there any period since 1929 that you wouldn't have come out ahead? So I ran some more calculations. So I averaged the annual S&P returns for every 30-year period, starting in 1929 to 1959, and then 1939 to 1969, 1949 to 1979, etc. And I did this all the way to 2019. And what I found is that if you had lived during any one of these 30-year periods, you would have made anywhere between 10.06% and 12.77% average annual return. And this is without reinvesting any dividends. So if you had reinvested dividends, you would have made even more. Which, I mean, this is just incredible to think about. And this is why I'm not worried about any coming recession. Because I know this strategy of having a well-diversified portfolio and holding it through a recession has worked time and time again, and the chances of it helping me to ride out any future recession is statistically very high. There's a really great quote that says, "Those who fail to learn from history are doomed to repeat it." So let's learn from the stock market crash of 1929 so that we can ride out any future recession. Alright guys, that's it for this video. Thank you so much for watching. Go ahead and leave a comment down below and tell me what you think of this investing strategy. And as always, make sure and drop a like, subscribe, and I'll see you next time.